Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
Thanks, everybody. Pleasure to be here. Steve, great to be with you.
As always.
I guess we're here talking about insurance. Both Steve and I have spent quite a bit of our careers working in insurance investment banking and deals both on the balance sheet risk-bearing side as well as the fee-based distribution side. And the insurance market is a resilient market and has been extremely active in 2025, and I think we continue to see that. In particularly on the fee-based side of the business, with a lot of strategic and private equity-backed groups looking for acquisitions, and I'm sure you're seeing that every day, Steve.
Every day.
There's all new entries that have come into the space, the legacy players, some very large transactions that were completed in 2025, including the acquisition of Assured Partners by AJ Gallagher and Brown & Brown acquisition of Risk Strategies. But yet even the smaller players, we're seeing those types of transactions. So I don't know, what else can you add to that, Steve?
Well, first of all, we're competitors, so that's why there's so much distance between the two of us. Friendly competitors, though. I think that's the nature of our little sector. I think if there's 5 or 6 of us that do what we do, it's a lot, and we all get along pretty well. In fact, we just completed a deal on the other side. We were on each side of that deal. And certainly from my perspective, once I heard it was Jason on the other side, I said, okay, this will be fair, and we'll get it done. So I appreciate that. What we're seeing, listen, it's insurance, M&A, and I suppose, that doesn't always generate excitement, but it really is. And maybe this will be a lively conversation. We'll prove that. But what we're seeing, and forgive me because it might be somewhat isolated from the rest of the economy or the effects of macroeconomics on our business, but we are insulated a bit because we see a lot of activity, and that's the nature of, I think, both of our firms. It's volume. We're the lower middle market, deal size anywhere between, I don't know, $5 or $10 million to, we're just about to complete a $500 million dental insurer. But we're seeing a lot of activity. It hasn't slowed down. People mentioned that it was slow at the beginning of the year. I think we saw a little of that. The first quarter was a little slow, but that was representative more of things that closed last year that were supposed to close last year, as opposed to them coming into this year. But then April, something hit the fan, and we closed 9 transactions along the insurance value chain, everywhere from agents and brokers all the way through reinsurance. So while the number was fairly large, that's supposed to be in our business, but it was the diversity of the type of deals that we were doing that really made a mark.
Yeah, I mean, I think some of the macroeconomic trends that people are thinking about, tariffs was in the conversation before that. In insurance, that's not really applicable, right? So obviously we'll have impacts on certain segments of the insurance space, in particular where you have import-export type insurance products. But insurance is a recurring revenue business, and it's ripe for private equity. It has large retention, right, of clients. So typically a really good agency has 85, 90% retention of their clients every year. So as PE looks for investment opportunities, they find the insurance distribution market as one that's very solid, a great place to invest. Obviously, you have a demographic where the baby boomers that have started insurance businesses are now coming to the age of trying to reap the rewards that they've created. So all of those things have compiled into a pretty robust market. And on the balance sheet side, right, we've begun, obviously, Sampo did a very big deal this year on the acquisition of Aspen, and we continue to see that. I mean, there's a lot of roll-ups on the balance sheet side of the business from, workers' comp companies, cyber companies, and that, I think, will continue, especially as larger companies are looking for new underwriting platforms.
Yeah. And let's give you a sense of what we're talking about in terms of that insurance value chain, what types of clients we have. It's everywhere. So if the value chain is insured to reinsurance, it's agents and brokers, wholesalers, managing general agents, which are somewhere in between a distribution type of entity and an underwriting entity, carriers, reinsurers, and I think your business is the same. That's in accident, health, life, and property and casualty. So it's every aspect of that. Now there's a ton of deals on the agents and brokers side, or let's call it insurance distribution, from that managing general agent down to the retail agent. I suppose there's 900 deals get done a year in that space. I could be wrong by 50 or 60, but it's a lot. So there's a lot going on, and that's what we're seeing it. But what's really driving a lot of what I think is going to happen in the next couple of years, and it has in the last two, and tell me if you've seen this, but we're seeing clients come to us now and say, I don't want to merge, I don't want to acquire, I don't want to raise capital, but I do need help. I want to find distribution, I want to find insurance capacity, I want to form a captive, I want to find a managing general agency. And at first I thought we were just getting lucky, but recently, I sort of put together a thesis saying, hey, where that value chain used to be sequential, it's become modularized, where data is available, technology is cheap, there's carriers that are out there, the fronting carriers that just lend their paper and licenses to issue insurance policies, and there's collateralized reinsurance. So because of that, groups are coming to us and asking us for other services other than M&A, but it's also driving the M&A process because now more people are forming entities to be sold.
Yeah, I mean, we're seeing much of the same thing, right? One, you're seeing, and for many of you who are not in the insurance space, a retailer is the person that's dealing directly with the insured, to like a managing general agent that may have the underwriting capacity for a company in a particular specialty line. So we're seeing a lot of those retailers wanting to go up the chain and to become the managing general agent and control more of that business. And then we're seeing the managing general agents that want to take risk through forming a captive, some of them, in some instances, forming their own insurance company and going further up that chain. And you're seeing another unique phenomenon in the industry is because of the way insurance distribution firms are valued, you have a lot of talent, underwriting talent, that are sitting at carriers, some of the big carriers that are saying, hey, you know what, now's the time to leave and actually start something on my own. Because if you're looking at businesses that are valued at really, even a small agency today is a 10 times multiple of EBITDA, right, up to 18, 20 times, you make a lot more money doing that than as an underwriter for AIG or Allstate or, pick the company. Yeah. So we're seeing a lot of carve-outs of people jumping, looking for carrier partners to facilitate them moving to more of an underwriting agency model.
You said it. And to put it in perspective, we have a due diligence practice, so we get to see the quality of sellers. They're really, really good salespeople. They know how to sell insurance and place insurance. They're not that good at writing it all down. So we see a lot of, I had an analyst come in and ask me if it was okay that the insurance agency, their books and records were handwritten. And I'm a former CPA, I had to think about it, but cavemen did it on rocks, so I think it's okay. And but can you imagine an agency selling at a 10 multiple? It was a $15 million deal, and their books and records were in crayon. So, so some of the quality is not the same, but they're for sale. It's a great, especially as Jason points out, in the retail business where you wake up as an insurance broker, and 90% of your income for that year is renewals, despite what Flo and Progressive says. Most people renew their insurance automatically. It's no accident that 2 of my 3 boys are insurance brokers, and the third works for me. So we love the industry.
Yeah, no, it's been great. And as Steve said, in a recent example of a deal we worked on, we represented a minority owner of equal owner of a wholesale insurance company focused on personal lines and small business. He was looking to exit as he was non-core to the management team. Steve represented the management team and the family that owned the other half of the business. And, it was a great opportunity because given the multiples of where the business is traded at, for our client who was looking to exit and cash out, he got a fair deal in terms of a multiple of that EBITDA. And at the same time, the market was ripe enough and the borrowing capacity within the insurance space is pretty fulsome. So Steve was able to help them facilitate some debt facilities and effectively, do a leverage buyout for the team and the family.
And they'll be a client of mine if you don't poach them for a while as they grow. A bunch of young guys who are not ready to sell. So, and that's a pleasure to keep clients year after year and for the long term and work with them. That happens a lot as well.
Yeah, and then we talked a little bit about the balance sheet side, but insurance carriers obviously, it's a very capital-intensive business, so you do see private equity that obviously come into play. There have been a number of startup companies in the balance sheet sector, in particularly the fronting sector, which we should talk about, but also some specialty players that have launched in 2024, 2025. The excess and surplus lines market has been very active in the specialty space. Delwood is a recent company that launched and looking to expand into that space. And I think we're going to see that continue. Fronting has really changed the game. I mean, back Steve and I got in the industry, there was really one game in town. Right? I mean, it was State National. You'd go and that would be who you get your paper from. Now, how many fronts can you name?
Probably 25 that are real, 22. I'll tell you this. In 2015, there was one game in town, State National. It was a monopoly. There was another entrant that was in his pajamas in his living room, and had his C-suite set up, but they were at other companies, and as soon as we raised private equity, they were going to come. That's not a great story. In an industry called fronting, we should change the name, and if it wasn't for the fact that I knew in the 90s that fronting was really a commodity, price-driven most of the time, I wouldn't have taken that deal, but we got it done. We closed that in 2015, Clear Blue. Now there are 22. It has changed the industry, and to the point where now I talked about the demodularization or the modularization of the value chain. That really helps. Having a fronting company where if I am a broker, all of a sudden I could step up the food chain. Oh, I shouldn't say that anymore. I got to go across the value chain because someone gave me a hard time. It's not above, but you could start to now pull down modules and solve a insurance or risk transfer problem by pulling down different aspects of the industry. And there is a flood of capital that's looking for it. Someone asked me about yesterday. Someone asked me about the decline in acquisitions in the MGA space. And I said the decline is related to the fact that there aren't enough good MGAs out there for sale. If there were double, there would have been an increase, right? Because there really is a ton of capital. When interest rates went up and buyers came and said, my valuation is going to go down because my cost of capital went up, my answer was, listen, you don't have to leave the line, but you have to get on the end of it. You're in the penalty box for now because don't even start with me. There's enough dry powder out there to sustain the valuations, and that's what we saw. Maybe less people showing up to the table. Maybe instead of the 12 buyers, there were 9, but that's okay.
Yeah, plenty of buyers, and we saw that same thing too. Valuations didn't change. I think what we did see was certain buyers, prior to the interest rate hike, you may have 15 buyers, right? And then after that, unless it was straight down the middle of the fairway for a particular party, if it was on the rough, right, they may not bid or they may bid less competitively. But there were still, there were still 2 or 3 foursomes that were coming straight down the fairway. So there was no lack of buyers, and really, despite the interest rate environment, valuations have at least stayed flat, if not trended slightly up.
Yeah, I think so. And like you said, what's the difference? If 12 people used to show up, now 9 show up, that becomes 3, then 1, and you close the deal. And, so it was okay. From the insurance distribution part, right where it connects with carriers down, the buyers and investors of those companies take us out to dinner and pay. Right, I think the carrier guys, we might have to buy.
You have better clients.
Yeah. Because I think they need us to find deals, and we'll continue to do that as long as we can.
And then maybe just in the closing minutes, talk about technology. I mean, everybody thinks about technology. And insurance is, I would say, like the last adopter of technology. I mean, it's a very, kind of archaic business in many ways. Although some of the newer players have come and begun to change things. But we had this boom, Steve, and you probably remember it probably 4 years ago, 5 years ago, where InsurTech was the hot word, and everybody was out there looking for InsurTechs. And now fast forward, 5, 6 years later, right? I mean, sure, there's some nice companies that have come out, but not many that have really changed the game per se. And a lot of the big companies, whether it was Munich Re Ventures or some of the other big players, they've really kind of closed down those operations and refocusing and looking at either developing that technology in-house or going and acquiring, smaller companies versus, a true private equity style investment. And I think that at least we've seen InsurTech values, drop in much less interest than we did 5 years ago.
We evolved. So it used to be, I would say, we would never look at an InsurTech for a technology for the sake of technology. And I'm glad you called it technology, not AI, because it's both, right? AI is transformative. It's going to change a lot, including the way we do business. I can give you examples in the M&A space of comparing LOIs to stock purchase agreements and finding the differences, and then getting a little cocky and say, okay, now draft a part of the SPA for me. And it did. Not only did it do the paragraph, but it put definitions and references other places. And what risk did I have? I gave that to a lawyer to look at, and all he said is, hey, those guys at TAG really do a lot more than they used to. But that will change our business. On the insurance front, for industry that has been late to adopt technology, it is the most applicable to technology. If you think about the amount of transactions that get done, the correlations, underwriting correlations. When you get your car insurance, they check your credit rating because they're correlated. Low credit rating, bad driver. There's more, right? We just don't know how to identify them yet, right? But if you could start to do that, if you could have AI look at a driver's eyes and his feet as he's braking and tell him he's tired, he's got to pull over, you're going to stop an accident. So loss prevention, loss control, and loss adjusting. Once the accident happens, for him to scan the truck and put that data in, or if a worker has a little device that shows how he's bending, it corrects it, it prevents the injury, and then if injury happens, it writes it down. If my water in my basement gets to this level, the sensor, down in the Internet of Things, not AI, so it says, hey, your water level's too high, something's got to happen. That's the perfect application of all this, not to mention the rate, quote, bind and issue policy part of the industry that has a ton of data that needs to be somehow manipulated. It's great and it's happening. And as long as it's embedded in the enterprise, technology for technology's sake, but make my platform better.
No, absolutely. And I think AI, which is, I think of differently than technology that we saw in the last few years, is going to be a disruptor in the insurance space, but it's going to be a disruptor in the way of streamlining things. And whether it's claims management, underwriting, policy issuance, there's just so many things that AI can do. And a lot of these insurance carriers are now looking to that to make acquisitions where things that can help them either, we have a client that's in the wholesale space, right? All their business is produced through wholesale channels, and found an AI platform that is an insurance agency, but will allow them to get access to retail, which is
Yeah.
a much broader market. So I think you're going to continue to see AI develop in the insurance sector, predominantly on the carrier side, but also on the distribution
Yeah,
side as well.
absolutely. I wrote my wife a love note the other day, and she asked if I was ChatGPT. And while it wasn't, it was from the heart. It might be next time. So,
Yeah, my daughter wrote a poem, and
Yeah.
she couldn't have written that. So, well, I think we are good on time.
Yep.
It was a pleasure talking to you all today. I'm sure many of you, insurance is not something you talk about every day, so appreciate you listening to us for 20 minutes. And Steve, always a pleasure to get to do this together. I appreciate it.
Look forward to the next deal.
Absolutely. Thanks.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.